What's up everyone, my name's Robbie. This is Robbie Meal, and today's video is it's gonna be delicious. Now, hopefully you watched my last video. If you didn't, ouch. So you should probably go watch that. This one is about the best Charles Schwab growth ETFs. The last video, you'll notice, was a bit faster paced, and I was able to make the video much shorter than some of my previous videos about this topic. So, I'd love to hear from you if you still think that this is a bit better than that one before. So let's just get going. Let's start the video, let's run the intro, and let's get started. All right, so the three best Charles Schwab growth ETFs for 2021. Here we are, coming in hot. So we have number one, the Schwab US Large Cap Growth ETF, SCHG is the ticker. The next one, the Schwab US Large Cap Value ETF, SCHV. And then finally, the Schwab US Small Cap ETF, SCHA. Now, some things you're gonna see here. First off, I'm going with two large cap funds. So one's a large cap growth, one's a large cap value, kind of banking on the fact that I think large cap stocks will hopefully do okay. Whether growth is going to outperform value or value is going to outperform growth, we'll see. But it's good to kind of diversify yourself, have both of these. So not a bad idea. And then the small cap ETF, small caps for a lot of last year did pretty bad, and then kind of like September, October, they went on like a tear. So, there are times when small cap stocks are going to do really well, and there are times where it's going to underperform. So having some small cap stock exposure could be good. I don't have a mid cap fund in here. These are just my top three here. So let's go over quickly. The expense ratio is 0.04% for all of these, extremely low. 4 basis points, so that's like nothing. The 10-year category rank, SCHG, it's in the top 22 best in its category, top 22% best in its category. SCHV is the top 30% best in its category, and SCHA, the top 16% best in category. And then a bit of distribution yield for some of these, 0.46, not a ton. But actually, SCHV has a 2.48% dividend yield. So get some growth, maybe get some yield. So it could be good. SCHA, not such a high dividend yield, but a bit. Next up, let's take a look at the growth over the past year. So if you had $10,000, what would that have grown to over the past year? So SCHV, it's approximately 15K or a 53% return. SCHV, 15K or approximately a 42% return. SCHA, approximately 18K or approximately a 75% return. So really quick, what you might want to take a look at here is, so SPY is blue. Also, the S&P 500 benchmark is a dotted line, so they're the same thing. So that's where you'll see this one. So that's how the S&P 500 had performed over the past year. 14,600 is what it would have grown to. Whereas you see SCHA got all the way up to $17,510-ish. So did a really good job. You're not going to get a 75% return every year. You will not. But it's had a great year. But let's take a look at the 3 years and then the 5 years. So on the 3 year, SCHG had a 20% return. Sorry, $20,000 or a 26% return. SCHV, 14,000, it grew to 14,000 or a 12% return. And then SCHA, it grew to 15,000 or a 16% return. And we can take a look here and we can see the only one that outperformed over the 3 years was SCHG. Growth stocks have had a really great past 5, maybe even 10-year period. So value has not done as well. One of the reasons why I do think value is something that should be in a portfolio now, because the past 10 years has been a very terrible time for value. Maybe it's its time to shine, you know what I'm saying? So that's the idea with investing. You have to kind of think of what's coming up next and not what's performed well in the past. So next up, 10 years, past 5 years, $10,000 grown to $28,000 or 23% rate of return, SCHG. SCHV, 18,000, 12% return. SCHA, 21,000 or 16% return. So again, SCHG doing the best, outperforming the S&P 500. Again, SCHA, the small caps, not doing quite as great. SCHV, the value stocks, definitely not doing so hot. Again, you know, value may be coming. It might be coming. We'll see. So let's go on to the 10 years, and you can just keep looking at this. We don't have to keep going over it. Pause if you want, but kind of similar results, which ones did the best and which didn't. Next, we have Morningstar metrics. So these are all 4-star funds according to Morningstar, SCHG, SCHV, SCHA, the 3-year category ranking and return versus category, and the 5 years. So the 3-year on this side, the 5-year on this side. Why do we care about this? Because we want to know the risks that we're taking and how risky the funds are and how they perform against their peers. That's very important to us. Now, we also want to know how risky these all are. And so this next few slides are all about risk, because I think that risk is probably one of the most important things that you can look at when you're looking at these ETFs. You should always take risk into consideration. I always say this, it's like beating a dead horse, I know, but make sure you understand the risks and you look at the risk metrics. It's very important. So the 3-year, you had a average risk versus the category, but you had an above average return versus the category, and that's good. So you want this left side to be higher than this right side. You don't want, let's say, for example, a high risk but a low return. Right? You want a low risk with a high return. That would be the best thing you could get, right? Very hard to get that, but of course, that's what you want to see. So these did pretty well here on both 3 and 5 year, SCHV, average on both. So that's okay, not too bad. And then SCHA, it had above average risk and above average returns, but it had average risk and above average returns on the 5 year. So these aren't doing too bad. They look pretty fine on the risk metrics. If we come over here to these next 3-year capture ratios, which are another way to kind of gauge risk, what we look at here is we say, how much of the upside do these ETFs capture? Basically, if you took the market and the market had a 100, 100 is the upside of the market. Does this get more upside in the market, so more than 100, so it does, and does it get less of the downside of the market, which means less than 100, and it does. So that's why SCHG is actually pretty good. It's getting more upside, less downside, which is what you want to see. Then you could, compare it to the category, and it's done better. Going back. The fund's percent drawdown from peak to trough, negative 16.42% over a 2-month period. And so that's kind of good for you to know, like, how much drawdown potential some of these ETFs do have. And then down here, and remember this is over the past 3 years, down here we have SCHV, so 89% upside, so not getting as much of the market on the upside and getting more of the downside. Again, value not doing as well lately, so one of the reasons. SCHA, a lot more downside potential risk here. It's small cap stock, so a little bit maybe more volatility, and it had 32% as the drawdown, so much more than these other two funds. Then on the 5 year, again, you can kind of just like pause, take a look, but better upside, good downside on the 5 year, kind of similar for the 3 year and the 5 year for both of these. And then we go over to another very important part, which is the risk metrics. And so if you take a look, the SCHG ETF had a 3-year alpha of 5.70, meaning alpha is outperformance. So capturing alpha is good. And so this has a 5.70, so that's good. Now, the SCHV had a negative 5.76, so not capturing the kind of alpha or outperformance. And then SCHA also not getting that outperformance. But as we know, like I kind of mentioned, Part of these are plays on these specific underlying kind of style of investing. So small caps and value as the style, as opposed to just growth with SCHG. The 3-year beta, 1.02, 1.01, and then 1.27. So beta being of 1, meaning against the market, how volatile is it? If it's a 1, it's as volatile as the market, right? It moves like with the market. So 1.27 means it's way more volatile than the overall market. So again, SCHA, more volatility, at least over the past 3 years in terms of beta. And then in standard deviation terms, which is, let's say the range in prices, 19.45 for SCHG, 19.31, and then we have 21.06. So the highest standard deviation of these all is SCHA. And so that is it. So I hope that this kind of helped. When it comes to risk, remember, take these into consideration. If you wanted to go with just one of these ETFs, have maybe a blend of all of them in your portfolio, just make sure that you kind of take the risk into consideration. The small caps have been more volatile lately, especially, and probably going forward, it's going to have a bit more volatility as well than maybe the larger companies, of course, but take that into consideration when you put your allocation of how much money you put into some of these. So maybe the more volatile ETFs, you don't put as much of an allocation into as some of the maybe less volatile. It all depends on your risk tolerance and how you invest. So thank you so much for watching. I hope this helped you. If it did, please hit the like button, subscribe if you want to see future content like this, and I've got some videos coming up on the end screen. I would love if you hit them coming up right now.